Hello. Going to talk a little bit about the closing journal entry. So, going to go ahead and share the screen. So, the closing journal entries. These would be the journal entries that are made at the end of the period after all the regular transactions have been posted, after you've run the trial balance, after you've done the adjusting entries, after you've run the post the adjusted trial balance, after you've done the financial statements. After at that point, you would then do the closing entries. So they're at the end of the period. And the only thing that comes after the closing entries would be the post closing trial balance. And then at that point, you close down the month and you start the next month or the next accounting period, basically. There are 4 steps to the closing entries. You're going to close out the revenue accounts, you're going to close out the expense accounts, you're going to close out income summary. The only purpose income summary has is it's where you put your revenues and expense account balances when you're closing them out. Then you're going to close it out to zero. And then you're going to close out the dividend account. So, and I'll give you an example of those in just a moment. The purpose is you want to close out all the temporary accounts. The temporary accounts would consist of the revenues, the expenses, the income summary, and the dividends, so that when you start your next month, you start with a zero balance, and any activity in those accounts is just within the current or are just related to the current period. So that's with the temporary accounts. And you also want to create the ending balance and retained earnings. Remember, the formula for retained earnings is beginning balance plus net income minus dividends equal ending balance. So by doing these journal entries, you're going to be transferring net income and dividends to the retained earnings account to give it its proper ending balance as well. So I got a real basic example here, but this will work. Got a few account balances here: service revenues, salaries expense, rent expense, utilities expense, and dividends. So the first step is we want to close out all the revenue accounts. Now, whenever you want to close out an account to zero, you want to look at what's the normal balance in that account, and you want to book an entry to that account that's just the opposite of the balance that's in the account. Now, the normal balance for a revenue account is a credit. So that means if you want to close a revenue account out to zero, you need to debit that account. So we would debit the service revenue account, and that's going to be for $25,000. And we're going to close it to income summary. And again, income summary's only purpose is it's where you put your in revenue and expense accounts when you're closing them out. That's its only purpose. Then it gets closed out, and so it never has a balance in it except for that one. It's its only purpose. Has a balance momentarily, and then it's closed out. So if you want to close out the revenues, you want to debit the revenue since they have a normal credit balance. You want to debit them, and you're going to close it out to the income summary account. Now, step number 2 is you want to close out the expense accounts. Now, expense accounts have a normal debit balance. So if you want to close out an expense account to zero, you need to credit that account. So we're going to start with our debit, which is going to be to income summary. And we'll come back and we'll add the total once we've got all of our once we've credited all the expense accounts. So we have what a salaries expense, and that would basically be a credit. That would be a credit of what, $8,000. We then also have a rent expense, and that's going to be a credit of what, $3,000. And then we have a utilities expense, excuse me. And that's going to be for $500. Excuse me, that would be a credit for $500. And so our total to income summary is going to be for $11,500. So we've now closed out all of the expense accounts to income summary. Now, the third thing we want to do is we want to close out income summary. So if we're going to close out income summary, we want to take what's the balance in there and we want to close it out to 0. So a good way to do this is to look at a T account. So I'm just going to create a T account here for income summary. And I will go ahead and just create a T account. Now, notice what we put to income summary. We credited it for $25,000 whenever we closed out the revenue accounts. And we debited it for $11,500 whenever we closed out the expense accounts. So remember how it goes when you're looking at T accounts. Larger side minus the smaller side gives you your larger side balance. So based on this information here, we would have $13,500 credit balance in that account. So if we wanted to close it out to 0, we would need to debit income summary for $13,500 in order to close it out to basically a 0 balance. So what we would do here is we would debit income summary for $13,500. And we would credit retained earnings for $13,500. So now we've closed out income summary to retained earnings. And our last step is we want to close out the dividend account. And basically the dividend account has a normal debit balance. So that means if we want to close it out, we're going to have to credit it. So in this case here, we would debit retained earnings. So that would basically be a debit of what, $2,000. We would credit dividends for $2,000. And now we've closed out all of the main accounts. So we've closed out all the temporary accounts, excuse me. So we've closed out the revenues, we've closed out the expenses, and we've closed out the dividends. And basically the net effect of this is all the temporary accounts now should have a 0 balance, and retained earnings should have the proper ending balance since we've closed out income, which is revenues minus expenses, and we've also closed out dividends to that account. So have a great rest of your week and get with me if you have any questions, and take care. Bye-bye.